everyone to today's webinar. Today's webinar is called GBQuarterly Year-End Business Tax Update, sponsored by GBQ Partners, LLC. Today's presenters are GBQ's Tax and Business Advisory Services Directors, Christine and Kevin Dunn. Now I'll turn the call over to our presenters to start today's webinar.
Thank you, Kyrie, and thank you to everybody that's joining us today. As she mentioned, my name is Christine. I'm a director in our tax practice. I'm joined today by my colleague, Kevin Dunn, who's also a director in our tax practice. We're going to spend about the next hour or so with you guys going through our year-end tax update specified on businesses. And the next slide kind of shows our agenda here. In the past, we've kind of started off with some more general ideas and kind of tried and true tax planning objectives, as you will, and then build our way up to ending with a legislative update and kind of the state of the IRS and some other things. This year we wanted to kind of flip it because so much has been happening legislatively. We actually want to start off with some of the legislative developments going on with the Build Back Better Act, some more recently passed legislation on infrastructure, and then kind of want to turn our attention to remind you of some changes. It's been a lot, the period of the last 2 years, there's been a whole lot of new tax provisions and legislation that's out there. Some of the stuff that actually came into being in 2020 with the CARES Act and some other items have a tail on them that either expire or change or something that is affecting the times now. So we want to pull back and remind you of some of those. Then we want to kind of put that all into perspective and say, okay, knowing what we know sitting here today, what are some tax planning strategies or some things to be thinking about as we head, as we close out another year here in 2021 and into 2022 and beyond. So with that, we'll go ahead and get started. I'm going to turn it over to Kevin to take us through the Build Back Better Act.
No, thanks, Chris. So I think probably everybody has seen that with the Build Back Better Act that the House has passed. It is currently with the Senate. There's a lot of uncertainty on exactly what is going to happen with the Senate, if they're going to make modifications to the bill. I think Chairman Schumer wants to try to pass something before the Christmas recess. Others have said that it may, bleed into next year, but it's something that we've got to keep on our radar and think about. And so what we've done here in the next couple slides is lay out some of the bigger corporate provisions that could impact companies. So the first one, I think initially they had talked about increasing the overall corporate tax rate from the 21%. They sort of modified that and shifted gears a little bit, and they've gone to the concept of a corporate alternative minimum tax. And so the corporate alternative minimum tax would be 15% on the book income for companies that have a 3-year average of adjusted financial statement income of $1 billion. And also a piece of the provision in there also looks at a corporation, a domestic corporation that is a member of an international financial reporting group, and it would apply to those companies as well if they're adjusted, the group's total adjusted corporate income is over $100 million. So the second piece of that provision is similar to the second pillar of the OECD's global minimum tax. It's very, very similar to that provision, and we'll see, whether this provision survives or if they go back to an overall corporate income tax increase.
So what's your take on this? I think you alluded to this. Where we started, if you go back to, I think, May, when the Biden administration put out the Green Book with kind of their legislative priorities and revenue raisers, the way this conversation started, it was very much increases of rates that were broad, right? They hit everybody. Corporate rate is going, I think they wanted to start at 28%. They wanted to bring top individual rate back to that 39.6 that it was before the TCJA, and they wanted to start looking at things like capital gains, long-term capital gains rates for certain high-earning individuals, and also talking about estate and gift limitations and thresholds. So what started out as a very broad net has kind of evolved, and there's been a lot of talk over the summer, and what should I be doing if I think rates are going up, rates are going up, rates are going up, and then come, November time frame when some of you get to look at some actual language, it appears that they're sort of scaling it down to, certainly much larger taxpayers is sort of what we're seeing here. And kind of transactions maybe to your next point, that aren't as common with closely held smaller business type of structures. Would you say that's kind of what we're seeing?
Yeah, I think that's what we're seeing, and it's hard to tell. I haven't seen anything specific on why they made the specific switch to the alternative minimum tax versus an overall. Part of it could be they cut back the spending side of it, and so the amount of revenue that they needed to offset some of the social spending is, lower, and so maybe they didn't need as much, and so maybe they're saving some of that for other, potential bills in the future.
It's just the political reality, I think you have to look at it, especially in recent times with inflation, that the political appetite for raising rates in this kind of environment may not have been as strong as they might have predicted earlier in the year as to where we sit as some of this legislation has started to come into shape, so to speak. So yeah, just keep that in mind, kind of where we've started, because this is something there's been a lot of speculation on, and it's almost getting confusing of whether they were talking about it or it's in the legislation, and we will try to kind of point those things out and make commentary where it's appropriate.
And I think one thing, Chris, too, that tax people have to be cognizant of is, again, this is looking at book income, and so you've got to, partner with the finance people, in your company to understand, are there going to be, items that will be, large income pickups for corporations for book purposes that maybe aren't, taxable from an income tax standpoint.
A lot of questions about how the nuance and the details of how you would pose this. It kind of makes sense globally, but there's a lot of what if this and what if that? And certainly who this applies to are going to be some of the stuff, if this in fact gets enacted, we need to be paying attention to.
Right. Yeah, and the second one on here is, again, it's like Chris said, it's targeted more to public companies, and so it's looking at public companies that do a corporate stock buyback, and the tax would equal 1% of the fair market value of the stock that is bought back. And it applies to repurchases after December 31st, 2021. And so, this has a narrow scope of, public companies that would be applicable to, but something to keep in mind as companies look to do potential stock buybacks. Then the third thing on here is amortization of research and experiment expenses. So under TCJA, the research expenses were currently deductible, and then it was supposed to be in 2022 that companies were required to capitalize those costs and amortize them over 5 years or 15 years if it was acquired or the research was done outside of the U.S. This Build Back Better Act provision would actually defer the date of having to capitalize until expenditures incurred after January 1st, 2026.
Yeah. So this is something that was actually put in motion back in the end of 2017 with the Tax Cuts and Jobs Act, as Kevin said, and it was sort of coming to fruition here, and it was going to require probably a lot more administration. Even if you weren't taking an R&D credit per se, the expenses that were deductible under the R&D provisions would have been required to be capitalized and amortized over a period. Just it's the timing of slowing those things down. And I think what they're trying to do here is not discourage maybe certain R&D activities, and maybe they just understood that it is very administratively burdensome, even if it is a revenue raiser, a time value of money kind of play, that maybe they don't have the appetite for it in the current environment. So.
Right. And then the next one is limitation on deduction for interest expense. So, TCJ gave us the 163J limitation. There's been a lot of talk about, companies that have foreign operations of, shifting the income amongst the different subsidiaries. And so what this does is it limits the amount a domestic company can deduct, which is 100% of the net interest expense. And basically the domestic corporation's amount of interest expense in applying the 110% is looking at its EBITDA compared to the overall group's EBITDA. So it's a mechanism to try to limit companies from shifting income or interest expense between different jurisdictions to get an answer that they want to, and trying to spread it out, to all companies based off of their EBITDA compared to the entire group. The next one, there were several different pieces of international legislation that were included in the Build Back Better Act. What we've done here is identify some of the key ones, both on FDII and GILTI, the foreign-derived intangible income, and the global intangible low-taxed income. There is a deduction for the income pickup for both of those, and for FDII, the deduction was 37.5%. This act would reduce it to 24.8%, getting to an effective rate of 15.8%. GILTI, the deduction is reduced from 50% to 28.5%, with an effective rate of 15%. And then also another provision added in there with regards to GILTI is applying it on a country-by-country basis rather than looking at it for all your foreign entities on a blended basis.
And so, yeah, we use the acronyms, and Kevin just told you a little bit what those are. But these again, are a relatively recent change to the international tax regime as it relates to U.S. taxation of foreign sources of income and other items that came along with their own set of deductions. So, in effect, what all these provisions are doing a little bit of revenue raising on foreign sourced income of U.S. Based taxpayers, as you can see. And again, I think this is something maybe they're targeting, like trying to stay away from something that maybe smaller businesses don't have as much of, and this is much more of if you have a bigger global footprint, these types of provisions would certainly be more applicable to you, and that's where they're looking to raise some of the revenue in this bill, and the presumption there, I guess, is that maybe there's a little bit more political willpower to do that on the larger multinationals than some of the domestic smaller entities. But certainly something that this has been changing, and if you work in compliance in this area, you can certainly attest it's a very complex and complicated reporting structure. Forms have been changing at almost breakneck speed, and keeping up with just compliance, even if it doesn't result in a whole lot of extra income tax effect, you do not want to kind of not be paying attention to this area of your business. If you've got anything international, you need to be really thinking about kind of your structure, how you're set up, how the compliance is being run, because you can get into trouble. And, as I said, a lot of these rules have changed relatively recently, so you need to think through, understand kind of how your global structure is going to get taxed, how the impact on your U.S. tax filings, and what the interplay between either a deduction here domestically or a foreign tax credit can work. And so definitely that's a theme you're going to see today with some of the other things, that compliance is getting more complex, and it's getting more complex in certain areas, and international is certainly a big area for that.
Yeah, and the last category is foreign tax credits. So again, they're looking at that and applying that on a country-by-country basis. Doing it at a taxable unit level, controlled foreign corporation, and then also there was a limitation on the carry forward of the GILTI category of foreign tax credits, and that limitation, is repealed as part of this. So, again, as part of the Build Back Better Act, there are a lot of provisions, a lot of things in there. I think the key thing to keep in mind is we just need to continue to monitor it. We'll, continue to monitor our side and get out, guidance as it comes out, as things, change and progress, as it moves its way through the Senate. And especially, corporations that are dealing with provision, you need to keep that in mind as you're thinking about year-end provision. If you've got a December year-end, you'll need to make sure you think about that and take that into consideration, as you're preparing your provision and valuing, potential deferreds, as part of that provision process.
Yeah, they take a little while. Yeah. So what we wanted to include, you may have seen some of this yesterday, we have a separate segment for the individual year-end tax update, but as many people know, your business can be structured as such that a lot of the income ends up flowing through to the individuals. So we wanted to include some provisions that maybe aren't on their own necessarily business-related, but can be depending on the structure of the business and the individuals involved. And so the first bullet point there is actually is one of the few rate increases that is in the Build Back Better Act, but there's a net investment income tax that they want to apply to certain high-income individuals. So the background here is back in 2013 with Affordable Care Act provisions that came in. One of the revenue raisers for all of this was to create this there's a surtax, there's also this net investment income tax that have a kind of an intertwined rate structure to pay for some of the provisions that they needed in that act. And so net investment income tax applies to what it sounds like it applies to, which is investment income tax, but it also applies to, in a pass-through business setting, certain owners that would get a K-1 from either an S-Corp or a partnership that were passive investors. They consider that to be in the base for net investment income tax. That has always been the case. There is, however, if you are non-passive in that same business, this kind of this 3.8%, again, the tax has been around since 2013, would not apply to those types of income. So you had kind of this differentiation between what applies to shareholders or partners based on their respective activity in the business. However, many of you know if you're dealing with somebody that is active in their trade or business through a pass-through sense, there's another tax that was always around called self-employment tax. And the self-employment tax kind of applied to everything that you would have from a non-passive in your trade or business status and your pass-through. And there was always a component, if anyone knows anything about self-employment tax or even the employment tax for FICA and Medicare, you essentially have a rate that applies to a certain amount of your income for the FICA limit, and then there was a portion that would apply to the Medicare portion of that. And so what this does, there was a little sliver of, if you were in a pass-through situation, and I think the one that they're particularly going after here is S-Corps with a non-passive shareholder. So the deal with the S-Corps with a non-passive shareholder were if you took a reasonable compensation out of there, that's one of the pass-through structures where you can also be an employee. Your K-1 income would not be subject to self-employment tax, and it also would not be subject to net investment income tax if you were non-passive in that activity. And so what they appear to be doing here is just broadening the net and saying, hey, if you're essentially any kind of pass-through form, we're going to make you kind of on equal footing with everybody else and make you subject to the 3.8% net investment income tax and kind of make everybody in a similar situation. Now you got people that have set up their structures already to take advantage of that. So there's kind of this, well, if this changes, what is that going to mean for entity structure going forward? I think that's a big question that will need to be thought through fairly thoroughly. If this becomes enacted. And then other things that happen. This could be a big, maybe the income every year, 3.8% is not a big dent on that, but there's also provisions when you have a sale. If you sell your business, there's a potential that you could not be, subject to the 3.8% net investment tax if you were a non-passive investor, an active investor, and that might change with some of this stuff. So there could be, a small percentage, but on a big income event could cause some, really change the economics of a deal that maybe that otherwise it wouldn't have. And so they don't double dip, as I said. The rates here, the reason it's 3.8 is that the Medicare rate on self-employment income is 2.9, and they've enacted a 0.9% surtax on that to get it up to 3.8. So 3.8 was kind of the level across both self-employment and kind of this passive investment income that they were trying to hit and put everything. And so, as I said, they appear to be going after the one little sliver in there for S-Corps that wants to put them on the same footing. And again, they're targeting for after this year, so shouldn't apply for 12/31/21 if in fact enacted. The next point there is there's a surcharge on high income individuals, estates, and trusts impose a 5% surcharge. And here's the key on modified adjusted gross income that exceeds $10 million for individuals and joint filers. That's a big, so, again, this is just adding, it is a rate increase, they're just setting the threshold very high. So the expectation there is that it would not affect a large number of taxpayers, but could impact income, once you get up in those kind of numbers, you might be talking about big dollars to those taxpayers to which this is subject to. And then again, imposes an additional 3% surcharge on modified AGI that exceeds $25 million for individuals and joint filers. So again, they're stepping up. They're kind of creating, I guess, in effect, another higher bracket rate that's just so far away from where the top bracket starts now, somewhere around 600 and some thousand. So you're kind of getting up to the very high end of earners before these surcharges kick in. And again, the theme here seems to be a little bit like we don't want to tax everybody, but if there's some that we can hit with some of these taxes to get a revenue raiser, then maybe there's more political will to do that on both sides. And so those are the only two real rate increases, so to speak, that we're talking about with the Build Back Better Act. And then this last point is you may have had this at the yesterday. Again, this is an individual tax provision, really, but it does have very much an interplay with business taxes, and that's the so-called limitation on SOL, state and local taxes. So with the TCJA that passed back in 2017, one of the offsets, they basically lowered the rates and gave some deductions and some tax favorables. One of the offsets was that they sort of limited individuals' ability to deduct state and local taxes on Schedule A. And so since 2018, they effectively have capped that at $10,000 a year. And there was a lot of uproar because if you think about it, not everybody really pays state and local tax equally. Depending on where you live and what kind of taxes you are subject to, that could be very different. So when you start taking away some of the tax benefits of those state and local taxes, what does that do? It doesn't hit everybody the same, and it could hit some people disproportionately more than others. And what really happened there, you had a lot of people that were upset that lived in high taxing states. So think of your Californias, New Yorks, some of the places where the income and real estate taxes are very large. Now you're taking away my ability to get any kind of federal tax benefit for those taxes that were historically being paid.
Yeah, so I guess another thing on that too is you've seen for corporations or pass-through entities that a lot of states have been enacting legislation to try to get around this to allow the flow-through entity to pay the tax and put a plug in for our state and local guys tomorrow. There's a webinar going on tomorrow on state and local tax issues, and I would assume that they'll probably get into talking about that provision a little bit more of the ability to potentially deduct the state and local taxes, at a flow-through versus on the individual partner's tax returns. So.
Yeah, that's a great point. So the theme there has been, since this happened back in 2017, effective for 2018, many states have been trying to rework their tax regimes to create it and say, well, wait a minute, if it's a pass-through entity doing business in my state, can I make it so that it's taxed on the entity to which the individual will get credit, so it's not any more tax that you pay, but by doing so, is it a workaround to this SALT limitation that has been in place? And there are, I think, like 19 states, and I don't want to get ahead of our state and local tax department, who we'll be talking about on the next webinar, but this has become a big thing because, if you look at a map of where a lot of the constituents for both parties live, there are a lot of folks in blue states that really want this, and a lot of kind of political spotlight you might be reading on this, that they're trying to get in a tax benefit for their state, which is kind of counter to their overall theme that might be, summarized as we want to go tax the rich type of scenario. So it's a political football that's being tossed around, and there's a lot of ins and outs, but that's the crux of the issue is kind of this, okay, what's going on with existing laws. And I guess I didn't even mention what the new rule that that's going through the Build Back Better, but they're trying to up that threshold little bit and cause some relief to that. So saying, okay, well, maybe not 10, we'll give you a little bit more, maybe move it up to 80, maybe, have it be subject to certain taxpayers and phase out. There's a lot of discussion around that point, and what ends up in the Senate version of this, I think, is kind of what you should be paying attention to, because I think that's where you're seeing a lot of the news stories on this topic.
Okay, so as part of this, to get CPE on the webinar, there's going to be 3 different CPE activity code words. The first one here is business, and so make sure you note that down. I think you need to identify that as part of the survey that you do that's sent out afterwards to get credit. Or during.
There's a poll right now that they can.
Yeah. Okay. So just check that box, or button there on your poll, and we'll move on.
Okay, the next section is there was the Infrastructure Investment and Jobs Act was passed by the House and Senate, and President Biden signed that into law on November 15th. It didn't really contain a whole lot of tax provisions, but the one that it did contain was a retroactive termination of the employee retention credit. We've got some slides later talking about employee retention credit and the benefit that it could possibly provide to companies. But originally the employee retention credit started in March of 2020, and it was subsequently extended a couple times through December 31st, 2021. And this bill actually terminated it, so you can only take into account wages paid through September 30th of 2021. The one carve out is there is a definition of a recovery startup business. If you began operations after February 15th, 2020, and you had an average gross receipts of less than $1 million during that period, that you could take employee retention credit without meeting the other criteria or the other qualifications that we'll go through of up to $50,000 per quarter. And so, Q3 and Q4 of 2021, you can get a maximum of $100,000. I got on here that it's unknown how the IRS will deal with this. Actually, a couple new things that have recently come out since we put these slides together. Within the last day or so, the IRS issued Notice 2021-51, which addressed situations where companies were, already considering and claiming the employee retention credit, whether they're getting advance payments or holding back deposits for the employment taxes. So if companies received an advance payment, they must repay that, and it needs to be repaid by the due date of the tax return. If it's not paid by the due date of the employment tax return, there may be some failure to pay penalties that will be applicable. And with regards to failure to deposit, if you hadn't made deposits up through December 20th with regards to wages you thought would qualify for the employee retention credit, you have until, the way they're treating that is as if you made a payment of all the amounts on December 31st, and you've got to make a deposit based off of your normal deposit rules for those wages that you were going to claim the employee retention credit on prior to the expiration. The notice also contains some reasonable cause exceptions. So if you have a situation where you don't meet one of these criteria and you get assessed a penalty, you have the ability to potentially claim reasonable cause. The other thing to bring up here too is it's interesting how the House and Senate passed the Infrastructure Investment and Jobs Act, which terminated the program as of September 30th. Recently, I think it was either end of last week or early this week, some senators are reintroducing, or House of Representatives are introducing a bill that would put it back in place for the fourth quarter. So unknown where that will go or what impact that may have, but that's something that's out there as well to keep in mind and think about.
Before we go on to the next, we got a question about the NIIT 3.8% tax on active shareholders. So the question was, the 3.8% IIT is on S Corp active shareholders or only passive? So maybe I wasn't clear about that. The existing rules already basically put into the base of NIIT passive. So if you were passive in a S Corp shareholder structure, you were always subject to this 3.8% NIIT if you were over the threshold of income at the individual level. And so what this is really doing is just pulling in the other half of that. You know, you can either be passive or non-passive. So it's pulling the non-passive portion into the base. And I guess in a real way, maybe if you had a position that you were taxed as a partnership, that you were a limited partner and also, or I'm sorry, a limited partner that is a non-passive but not subject to self-employment tax, which is, I think, kind of a rare, very small sliver. I guess maybe it's pulling those in too. But essentially, I think it's getting all pass-throughs to either you're subject to self-employment tax or this NIIT. And the only real difference between those two, the math kind of works out similarly, is that the half of your self-employment tax is deductible at the individual level. But thank you. Yeah, I should have clarified that. So moving on, the next slide here, the IRS kind of some of the requirements that have been coming out. And so what we're trying to paint a picture here is some themes that we've been seeing, not just in this latest round of disclosure requirements that are coming out, but it seemed to have been a trend the last several years now, where the IRS, instead of doing enforcement through their traditional means of sending agents out, plucking people for exam, the normal things that the tax authorities do, they're almost reversing it and putting more onus on taxpayers and their tax preparers to do reporting. And we've seen this in the partnership world the last couple of years has been drastically changed. If you get a K-1 from a partnership, you've noticed that there's been more and more information that's been coming on those. They started requiring to have capital accounts reported on a tax basis, so essentially trying to have some of that tracking done by the partnership and the tax preparers that are reporting that information. There's other items related to 751A hot asset type of situations, 704C, which has to do with built-in gain properties contributed to a partnership. There's a lot that's been happening behind the scenes here. There hasn't been a lot of announcements to, but the IRS has just been layering on and changing these forms and putting more onus on taxpayers to provide certain information. And the latest round of this comes in the form of these new proposed schedules K2 and K3. So anybody that's a partner or a shareholder in a pass-through entity knows that K1 form. They may look a little bit different from year to year, but essentially it's the same thing. What's my share of income here, there, or the other? And it came with certain footnote disclosures and other items. What they're doing is essentially adding on to that form. And these K2 and K3 forms really relate a lot to international operations and reporting items. So getting more specific around reporting to partners and shareholders the kind of information that they would need to figure out some of this international filing at the individual shareholder or partner level, they are now putting that more specific into forms. And I want to say, Kevin, you've seen some of these forms. We've talked internally about them. They are robust.
Yeah, I think there's total, approximately 40 pages between the two.
Yeah.
And so just a lot more information. The other two items on here, cryptocurrency reporting, so the Infrastructure Investment and Jobs Act, expanded the definition so that that activity needs to be now reported, as well as part of the Build Back Better Act. There was a push to require banks to report activity, deposits and withdrawals exceeding $600. There's been a lot of pushback, but it's just something, again, to keep in mind and monitor and see where the IRS goes with regards to reporting.
And so, I guess, go back to that one second. So one of the things, I guess, before we leave that slide, the K1, as it currently is, if you take out the page with codes and the footnotes, is one page. You amplified this thing, so even if you don't have to do any of this reporting, but you get these K1s, you should be, prepared to possibly have a lot more information on those things that you need to figure out. And so, if I can plug my, put in something good for us and our brethren. The theme here is be patient with your tax preparers. There's a lot more information they are asking us to gather up, disclose, put on there. It is affecting timing. It is affecting fees. It is affecting a lot of things that they're asking tax preparers and taxpayers to do. And the cryptocurrency thing, they've been dancing around this for a while, kind of how should it be regulated, what should we do, is it more people are becoming traders of this stuff, but there's not the same rules as you would a traditional broker where you're getting 1099s that tell you, okay, here's your cost basis, here's the proceeds, the things that you need to report that. So again, this is another situation where the IRS is trying to put the onus on other entities or bodies outside of themselves to make some filing requirements that would provide this information to maybe close a tax gap, so to speak. Okay, that kind of moves us through either recently passed legislation or pending developing legislation, and brings us back to put in some reminders. So what we wanted to do is, some of the stuff that's passed here recently or been adjusted or amended temporarily by something like the CARES Act that passed in March of 2020, just to remind you kind of what the cycle of rules are and put a couple seeds in your head of things to be thinking about. And so 163J, Kevin talked about a little bit in the context of maybe some international aspects, but 163J is another provision that came around with the Tax Cuts and Jobs Act. It effectively, for certain size taxpayers, created a potential limitation on how much interest you could deduct every year. Again, I've got acronyms here, but ATI is just adjusted taxable income, which there's a definition for it, but we tend to think of it somewhat similar to an EBITDA formula. And so the general rule is 30% of that adjusted taxable income would be your annual limitation. Anything over that amount would either be suspended and carried forward, and you test again on an annual basis. When 2020 pandemic hit, CARES Act effectively loosens some of those and changed it from, the 30% limitation back to 50% and gave a couple other favorable limitations, but that was temporary. And so not only was it a new legislation when it started in 18, it kind of danced a little bit and came back to where the original version was meant to be. There were also some schedules, as I said, ATI had the definition of EBITDA, and the DA is important, that's depreciation and amortization. When it was first enacted, and it's still enacted, that is scheduled to drop off, starting, is that after? I can't remember, it's 2022,
yeah,
right?
2022.
Yeah. So we're on the cusp of something where the limitation calculation is going to change, and so people have finally gotten used to the idea of this provision, and now it's going to change a little bit, so just keep that in mind. And think about that, and think about how that relates with other provisions that I'm talking about. So the next one on bonus depreciation, that's another one that we've been in an environment for a relatively long period of time now where there's almost been immediate expensing through one version or another, but a bonus that says, hey, whatever property you place in service, if it was qualified property, you can immediately deduct it. But that, even when it was enacted, has had a sunset period where it starts coming into play here in after 2022, and in 2023, there's kind of a phase down to 80% of qualified property, and then it's going to keep going down until it's phased out in 2027. And so this is another one that it's always been set to sunset. They keep extending in some way, shape, or form. So this one is, this is what it is right now, but pay attention because this is another thing that could be changing. But if you also think about it, is it an add back in your EBITDA formula for 163J? What happens when it's not? And if we're on the cusp of those rules changing, is there a play that you possibly would make a decision to place property in service in a different year than you normally would have?
And part of the reason too that we wanted to bring up these two provisions is, as you're doing, cash flow forecasting and working with your finance teams or, looking at what the tax impact is going to be. It's something to keep in mind as we look out over the next, year or two and stuff, and just what may be happening and what impacts there may be to the forecasting process that you guys would go through.
And one of the other provisions that we didn't think we'd have time to do a whole deep dive on, but wanted to just mention is net operating losses. That was another thing that changed dramatically with the TCGA, no more carry back, right, carry forward, and a limitation on how much you can use. That got eased up and even expanded for a very taxpayer-friendly window from 2018 to 20. So we're out of that CARES favorable window back to the old new rules, if that makes sense, what they are. So paying attention to that, how that factors into some of these other items, you really got to take a holistic look at, well, if I'm doing good things here, does it factor in over here and maybe take away some of the power of what I'm doing over there? And then this last point, we don't spend a lot of time with this, but this is going back to what is already being talked about, possibly being changed here in the Build Back Better bill, which is starting in 2022, they were going to, and this is how it is right now, but there's some anticipation that in the final version it'll be maybe relaxed, that you don't have to go to this capitalizing and amortizing your R&D expenditures. So another kind of new provision there is this limit on what's excess business losses for non-corporate taxpayers is 461L. This was another one, came in with the TCGA, and effectively what it did is limited certain taxpayers' ability to deduct effectively business losses against non-business income. So think, pass-through entities, Schedule C, that might have a loss coming through from that aspect, being able to utilize those losses to offset other things like wages or investment income was always available. They started to put limitations on this, as I said, when it came in 2017 Act, to limit that to, I think it was $500,000 a year. And again, that was all set and good. That was sort of the offset to the favorable rates and things that came out of TCGA. COVID hits, and CARES Act does something similar to what I just talked about with net operating loss. There was kind of a temporary freeze on this, and it's coming back. What this one is, I think it was supposed to be a temporary thing through 2026. I want to say one of the items, I think one of the bullet points in the earlier slides on the Build Back Better Act, there is. If it's not, I think it is in there that they're trying to make that permanent. I think it's kind of like a revenue offset. So again, the theme that you're seeing in some of these recent acts is not raising rates outright, but are there other things like limiting losses or slowing down the use of losses that produce kind of a desirable outcome, I guess, for them in terms of revenue raisers when they're doing all the math on this stuff. The deferral of employment tax, that's another one that it kind of happened fast. When the CARES Act came up, people were taking advantage of this, and there was a long window and tail on this of when you had to pay it back. It brought in natural questions of when, if you're deferring, making these deposits of employment tax, when do you get the deduction on that? And so, cash basis taxpayers, it was probably a little bit more clear. The accrual basis one, there's kind of these general rules about recurring items that had to be taken into account for those. But that's another item. If you're set to split it between two tax periods and you don't need the deferral anymore, but you want the deduction, maybe that's something to consider. If you think your rates are going up because of the NIIT or you're going to be in one of those other brackets, you may want, that's part of also the overall things that we're talking today, is what happens if you think rates are going up. The general rule of delaying income or accelerating deductions may be flipped on its head a little bit because there's a little bit more power to them in a higher tax rate environment, factoring in all other things like time value of money and the like. So again, the theme is sort of an overall holistic approach of looking at these things and keeping them in your mind as you close out another year here.
Yeah, and the last item there is the Consolidated Appropriations Act loosened up the rules with regards to meals and entertainment expense. So typically, they're subject to 50% disallowance. The Consolidated Appropriations Act eliminated that so that companies could deduct 100% in 2021 and 2022. There were two recent IRS notices that came out, Notice 2021-25 and 63, which provides some definitions with regards to that law that came into play of what is a restaurant, being a place that prepares and sells food and beverages, excludes like grocery stores and things like that. And then the last one there, the 2021-63, allows the meal portion of your per diem if you're traveling away from your home to be part of that 100% deduction as well.
And again, the theme here was some provisions that they kind of discourage a certain amount of behaviors. COVID hits, restaurants get absolutely killed. They're trying to maybe encourage a little bit more by, offering more tax benefit to the customers that would frequent those establishments by giving you a little window of a break here, which tracking meals and entertainment has always been a chore unto its own. So this gap of a different treatment, something to pay attention to and really think about, not business as usual as in every other tax year. So.
Yeah, here we've got our second CPA activity code regulation. So as that pops up, make sure you record your answer for that as well.
Once that closes. So again, having set the table with some themes and some pending legislation, existing legislation, reverting legislation that is kind of in the current environment that we're in on the cusp of 21 and 22, what are some things to be thinking about and really considering in this environment? So accounting method changes I always put in there. So this is, again, thinking about, well, what are the items that I have that could either defer income or accelerate deductions, and is there a play there that I want to look at? And this has always been around. One of the things that's happened recently is some of the things with how you're treating the recognition of advance payments. So if you're in the kind of business where you receive advance payments before you render your service or sell your product, there's always been kind of this accounting method out there. It's been codified. There's a way to change to it rather administratively easily compared to some other changes. Those are considered automatic changes that you would be eligible for to say, hey, if I wasn't on this method and I determined that I could be eligible for this method and it would be favorable to me, this is something that you can do by filing a Form 3115 with your timely filed tax return and being able to take that, and as most folks might have some awareness of, when you're talking about changing from one accounting method to another, there's a prescribed method for how you include those items as income or deduction, and if they're favorable, meaning in the taxpayer's benefit, you can generally take those all in 1 year. And so you wouldn't make the change, right, if it wasn't favorable to do so. So being able to do that and do it all in 1 year is still a viable strategy that's out there. There's also, as I said, if you think rates are going up and you have been contemplating any of these kind of changes, do I want to do it in 2021 and 2022? I can get the benefit faster, but it might be at a better rate. Those are the things you just really want to map out and talk through with your advisors and trying to figure out. A couple years ago, what they also did was higher some of the thresholds for what they consider small businesses, somewhere around 25 million index for inflation. That impacted a lot of things. One of the things was also being able to be potentially on a cash method of accounting and being out of the UNICAP 263A rules, some of those items that are still out there that maybe it didn't make sense or you didn't see them the first time to make those changes if you were eligible for such last year, but those might still be around and are worth taking a look at and making sure you're on the method that's best for you and your organization. Another one that's been out there for a long time is possibly expensing of prepaids under this 12-month rule. This is usually you see this with insurance or maintenance contracts that have kind of an annual renewal. For GAAP or book purposes, you might be amortizing those amounts over a period of 12 months or so. There are favorable tax rules if you are on this method to accelerate some of those deductions. And again, that's another method change that I think is relatively easy. And then there's always things going on with depreciation, right? If you want to maybe take us through that part of it.
Yeah, so on depreciation, we talked about the, bonus provisions of those sort of tailing off and reducing, 20% per year till it's phased out. So, evaluating your capital expenditure plan, do you want to, work with your business partners and maximize maybe some of the spend in periods when you've got, 100% bonus depreciation? Another, common idea and area to look at is cost segregation studies. So, typically when you, do a build out of a building, everything gets lumped into 39-year property. You can go through the process of doing a cost segregation study and breaking out the total cost of that construction into various components and get some of the items identified as 5, 7, or 15-year property, and being able to claim bonus on those. We've got a team here that, looks at those and does that work, and we can definitely help you with that. And then also qualified improvement properties. So there was what they call a technical glitch in TCGA that, did not treat 15-year property as bonus eligible, or the qualified improvement property as 15-year property. The CARES Act went in and basically clarified that, and so now it's clarified that qualified improvement property is 15-year property, and it is eligible for bonus depreciation. So just another area to keep in mind as you're thinking about some of the different areas to possibly accelerate some deductions and minimize your overall taxes.
That's generally like real property, internal, retailers, restaurants. Those are the ones that you see maybe a lot in that bucket. And so, again, that was something that they probably always intended, but got codified when they did the CARES Act. And I think there's also method changes if you weren't doing that before on those. So definitely want to vet that.
I know we're running low on time, so we'll go through these last few slides probably pretty quickly and stuff. But just wanted to, I mentioned before, wanted to bring up the employee retention credit. So it's been around, since 2020. When it was originally enacted, it was a 50% credit of qualified wages up to $10,000 per employee for the entire year. And so the maximum that you could claim would be $5,000 per employee, whether it be Q2, 3, or 4 of 2020. In 2021, they increased that credit from 50% to 70%, and they look at wages being paid up to $10,000 per employee per quarter. And so it's a pretty favorable benefit for companies if they can qualify in 2021 to claim that. You can get a maximum of, I guess this was written when we had 4 quarters, for the $28,000. Now that it's only 3 quarters, you've got the $21,000. And then, also the rules to be eligible to count all wages paid to employees. For 2020, you had to have 100 or fewer full-time employees, and in 2021, they eased those restrictions and made that 500 or fewer employees instead of the 100. So a lot more companies, are eligible for it in 2021. We're seeing, we've got a team that works on the employee retention credit, and we're seeing some significant amended 941s that we're filing and claiming credits. The next page here sort of goes through and lays out some of the specific criteria. The first one is that if your business was fully or partially suspended as a result of a government order limiting your ability to do your business, and it has to be related to COVID. That's more of a subjective type of test. That's an area where there may be, there's not a lot of guidance from the IRS with regards to, and there could be a lot of subjectivity in how the IRS will ultimately audit that. The other one's more quantitative, so you have a significant decline in gross receipts. And when you look at gross receipts, you're looking at more, other things like interest income, gain and loss on sale of assets. In 2020, you had to show that you had a 50% decline in gross receipts as compared to a similar quarter in 2019, another restriction, or easing of the restrictions, is that you only have to show a 20% decline, or that the 2021 quarter's gross receipts are 80% of the same quarter in 2019. So again, going back to and sort of tying you back into 2019, a pre-COVID type of period. The last point we got on there is, with the employment environment and stuff, and a lot of companies looking to hire new employees and bringing back employees that maybe were furloughed, there's the work opportunity tax credit that's out there that you should keep in mind and consider as you're going through the hiring process. And then the last slide that we've got in here is just sort of, it's more of a reminder. IRS issued final regulations in 2018 with regards to UNICAP, which is Uniform Capitalization for tax purposes. It eliminated the simplified production method and replaced it with a novel term, modified simplified production method. And really the key thing there is it creates two ratios instead of one, a pre-production and a production ratio. We've seen some companies that we've worked with on method changes with regards to this that have seen some benefits if a larger portion of their inventory is in raw materials or goods purchased for resale, where you could apply likely a lower pre-production ratio to. So something to keep in mind. There's automatic method change procedures that you can follow as well to be able to switch to the new method. So. And then with that, I guess I know our time is up, and we've got our last CPE activity code of guidance.
Yes, I want to be respectful of everybody's time. If you send in a question, we can respond to that kind of offline just to make sure we hit it. And we thank you for your time today. And I hope you found this useful, and stay tuned. I think the next one in the series is the state and local tax update, which is great, and we appreciate it. And everybody, have a great day.